To implement the task given under the Managerial Finance course, our group has agreed to choose property industry for implementing the analysis. Taking into consideration with the number of developing and expansion companies related to this property industry, we have agreed to choose our 4 companies, which are Glomac Berhad, Masing Group Berhad, Darby Berhad, and Sunway Berhad. Shareholder analysis is a review function publicly held companies to discover information about individuals and groups owning stocks in their companies. For example, the analysis might have list of the top 30 shareholders ranked by the numbers of shares owned or value in Ringgit Malaysia, as well as location, legal status, or any other metric predetermined by the. Next, we identified the total value of the issued and paid up share capital, or the total amount of capital funded by a company's shareholders. According to the same annual report, Darby Berhad has recorded the highest value, which is 3.105 billion ringgit, and the lowest is Glomac Berhad, which recorded 727.821 million ringgit. If we break down the classification of shareholders, Masing Group has the highest percentage of company's shareholders, which is 85.42%, and for the individual shareholders, Darby has the highest percentage, which is 79.72%. In the business world, the definition of risk is the chance that an investment's actual return will be different than expected. Risk means the company has the possibility of losing some or even all from the original investment. Therefore, beta ratios are being used to measure the risk of an investment relatively to the risk of a comparable market benchmark. Thus, to calculate the beta ratio, we gather the respected data for our companies and analyze their risk and return profiles. Based on the analysis above, it shows that all companies have a beta less than 1 except for Masing Group, which recorded 1.08 beta. For other companies with beta less than 1 has indicated that their investment is less volatile than the market and vice versa. Among the 4 companies, Masing has the most volatile investment because its beta is more than 1 compared to Glomac Berhad, Darby Berhad, and Sunway Berhad. Other than beta ratio, we could use also weighted average cost of capital or WACC for appraising future projects subject to business risk and financial risk of the company. It is also to estimate the expected cost for all of its financing sources. This includes payments made on debt obligations or cost of debt financing and the required rate of return demanded by ownership or cost of equity financing. Based on the WACC formula, Masing Group Berhad has generated the highest WACC, which is 6.86%, and the lowest WACC among the 4 companies of Darby Berhad, which is 5.41%. A higher WACC is typically a signal of a higher risk associated with the company's operations. Investors tend to require additional return to assume additional risk. Most publicly listed companies have multiple funding sources, so WACC attempts to balance out the relative cost of different sources to produce a high single cost of capital figures. For Masing Group Berhad, which is the highest WACC 6.86%, it means that the company must pay to the investors an average of 0.0686 ringgit in return for every 1 ringgit in extra funding. The income that results from investing can come in many forms, including profit, interest earnings, or appreciations. Investing refers to a long-term commitment as opposed to trading or speculating, which are short-term and often deal with heavy turnover and consequently a higher amount of risk. A company with a negative cash flow from investing activities should be evaluated on the sources and uses of cash under its cash flow from investing activities. As these 4 leading property companies, they have decided to invest in long-term fixed assets, it will appear as a negative use of cash within the company's cash flow from investing activities in long-term assets such as property and equipment. It's actually a good thing that the company is investing in growth, as they have forecast the further price of property might increase in coming years. As a comparison, in these four companies, Darby Berhad had investing in large sum of money in property for their capital gain, as it shows the higher return in their revenue and profits. As a reason, behind Darby also the most stable company, as it is a pioneer in this industry.
Capital structure is a mix of a company's long-term debt, specific short-term debt, common equity, and preferred equity. The capital structure is how a firm finances its overall operation and growth by using different sources of funds. Debt comes in the form of bonds issued or long-term loan notes payable, which equity as common stock, preferred stock, or retained earning. Short-term debt, such as working capital requirements, also considered part of a firm. A company's proportion of short and long-term debt is considered when analyzing capital structure. Debt ratio is a solvency ratio that measures a firm's total liabilities as a percentage of its own assets, in a sense that the debt ratio shows a company's ability to pay off its liabilities with its asset. In other words, this shows how many assets the company must sell in order to pay off all of its liabilities. This ratio measures the financial leverage of the company. Companies with higher level of liabilities compared with assets are considered highly leveraged and more risky for lenders. This helps investors and creditors analyze the overall debt burden of the company as well as the firm's ability to pay off the debt in future uncertain economic time. From your pure risk perspective, lower ratio 0.4 or lower are considered better debt ratios. Many investors look for a company to have a debt ratio between 0.3 and 0.6. Thus, for Glomac, Masing, and Sime Darby, they earn 0.4 debt ratio, which is considered the best and adequate obtain debt to optimize company financing. However, Sunway having high debt ratio of 0.5, which is more risky and more leverage. The companies paid the dividend and distribute their retained earning back to shareholders as their reward on investment. Likewise, fulfilling the corporate practice of maximizing shareholders' profit, it is not unusual to see certain companies embrace no dividend policy as it favors retaining the earning to drive organic growth of the company for better returns, thus reflecting it via the share price and allowing better capital gain over the long run. Healthy retained earnings are one of the primary pointers in determining the well-being of the company. From the above table, the highest total dividend was from Sime Darby, which is 2 million, followed by Sunway, Masing Group, and Glomac Berhad. For dividend per share, the highest dividend per share also from Sunway, which is 37 cents, followed by Sime Darby, Masing, and Glomac, while the highest earnings per share was from Sunway Berhad, which is 41.77 cents. The highest dividend payout ratio is from Sime Darby Berhad, which is 67%, while the lowest company that paid dividend is Glomac Berhad, which is 14,000. Sime Darby was the best company that distribute dividend to the shareholders. Payout ratio is the proportion of earnings paid out as dividends to shareholders, typically expressed as a percentage. The payout ratio can also be expressed as dividends paid out as a proportion of cash flow. The payout ratio is a key financial metric used to determine the sustainability of a company's dividend payments. The highest dividend payout ratio is from Sime Darby Berhad, which is 67%, followed by Masing, 40.5%, Sunway 37%, and Glomac 36%. A growth company is any company whose business generates significant positive cash flows of earnings, which increase at significantly faster rates than the overall economy. The growth of the company is measured by revenue, profit before interest and tax, net earnings, and return to equity. Darby Berhad is the company that gets the highest revenue, which is 43 million, followed by Sunway Berhad, Masin Group Berhad, and Glomac Berhad. Darby also the company that gets highest profit before interest tax, which is 3 million, and highest net earnings, which is 2 million. The return on equity ratio, or ROE, is profitability ratio that measures the ability of the firm to generate profits from its shareholders' investment in the company. In other words, the return on equity ratio shows how much profit per dollar of common stakeholder equity generates, while for ROE, Masin is the company that grades highest ROE, which is 12%, followed by Sunway, Glomac, and Sime Darby. According to our analysis, Sime Darby shows the highest in terms of market capitalization at 60.6 billion, followed by Sunway at 6.3 billion. For Glomac and Masin, the market capitalization are at 509.5 million and 359 million respectively. Masin reporting effective property sales recorded at 22.87%, the highest among the 4 property companies in the year 2015, and these sales also achieved higher than industry average, which was 15.2%. Sunway's property sales recorded at 7.48%, lower than industry and property sector average, followed by Sime Darby at the 0.99% and Glomac the lowest sales recorded at 0.63%. All the companies have achieved earnings per share growth lower than the industry expectation, which was 18.71%. Sime Darby and Sunway in fact recorded negative growth for the financial year. For the dividend, in terms of percentage, Sunway recorded 28.27%, followed by Masin at 18.38%, higher than property sector expectation 17.49%. However, for Glomac, dividend recorded at 2.34% and Sime Darby at negative 2.09%. If we compare the companies with their capital spending, Masin spent recordedly at 58.11%, the highest among the 4 companies, and double than industry and property sector expectation average in the year 2015. These capital spendings are also recorded higher for Sunway at 28.45%. Nevertheless, Glomac recorded at 20.88% and while Sime Darby at 7.34%. In conclusion, we would like to recommend that Masin Group Berhad is the best growth company based on the 5 years growth analysis due to the property sales recorded at 22.82%, the highest among the 4 property companies, also better than industry average expectation. Revenue, which Masin recorded at 3.1 billion, with profit before interest and tax at 500 million and net earnings at 386.7 million. Masin return on equity achieved at 12%, which is also the highest as to compare with others. Dividend paid out ratio, Masin recorded at 40.5%, with dividend per share at 6.5 cent and earning per share at 0.87 cent for the year ended 2015. In terms of debt ratio, Masin earned 0.44 debt ratio, which is considered the best and adequate obtained debt to optimize company financing. If we break down the classification of the shareholders, Masin Group has the higher percentage of companies or institution shareholders, which is 85.42%. Nevertheless, in terms of risk analysis, Marsin Group recorded 1.08 beta, which is the most volatile investment because it has beta more than 1, as to compare with Glomac, Sime, Darby and Sunway with beta less than 1. For Marsin Group Berhad, which generate the highest WACC with 6.86%, it means that the company must pay its investors an average of 0.0686 in return for every 1 ringgit in extra funding. We do hope you can benefit from our group presentation. Finally, we would like to express our sincere appreciation to our beloved Professor Dr. Rashida and our beloved friend that helped us making this video a reality. Thank you and all the best.